All right. We missed last week. Did we miss 2 in a row of this?
No, we missed one Tuesday.
Just one. Because I went away on a Thursday, so I think we did the one right before. Anyway, I missed you guys. What's up, Pounders? Let's say hello to some people really quickly, and then we'll get into our sponsor. First things first, Canadian 3000. Dead cat bounce or bottom. That's like the main point we're going to try to make on the show today. So stick around for our takes on that. Eric Barros, I see you. Basil. Who else is here? Cliff Peebles is here. Kelly SF. Dave Ary. Roger Weatherford. Josh Weepy. Jay Luther. All the regulars are here. Miss you guys so much. Thanks for coming back. Tonight's show is brought to us by
our friends at Y Charts. John, you have this first little teaser chart that I threw in the doc. I stole this from JC. Josh, did you know? Did you know that Apple is making a relative all-time high to the S&P 500? Apple has never been stronger relative to the S&P 500 than it is today. Yo, stop calling.
Is that bullish, though?
Goodness.
What is a ratio chart?
Is that
Apple
bullish?
versus SP? I don't think so. I feel like this is how, this is not a great sign. That the biggest stock breaking out relative to the entire stock market is not really great historically.
It's in the eye of the beholder. I don't know. But anyway, I do ratio charts on what don't I do on Y Charts? That's the question.
Y Charts has mad tools. I was doing some economic data stuff on there, which I never do, and I don't really know what I'm doing, but I was doing it anyway, and they have more on there than you'd think. Anyway, check out Y Charts if you haven't yet. I think we have some kind of an offer beneath us if it's your first time. So give it a shot if that's the case. Y Charts is
suits.
Yep. That's how things used to be in the before times. Okay. I'm going first tonight. That's really the big question is was that it? Did we see the bounce and now do we roll back over? I would say that there's no evidence that this whole thing is just going to retrace and roll back over. So I would not be confident that that's what's about to happen. But, of course, anything can happen. I want to give you my reasoning, though.
No evidence of what? There's no evidence that was not the bottom? What is that, a double negative? What are you saying? That was the bottom? What are you saying?
It would be very hard to make the case right now that we're about to give up the entire bounce from the June lows.
I agree with you.
There's nothing telling you that that's likely based on the things that I look at.
Okay,
there's nothing. There's nothing. You have good participation. You have great internals. RSI's confirming. You have a lot of the right leadership. You have actually good news flow supporting a lot of what's going on with the rally. So I wouldn't. I'm still somewhat bearish, but I don't feel we're going to lose this whole bounce right now. I just don't. That's not how I personally feel. But
are we on the same page? We might be on the same paragraph, the same word.
Well, I want to. I don't know if we have just a straight up S&P chart. I should have asked for this. But what I want to do is the VIX versus the S&P. I forgot if I asked Sean for this.
It's in here.
Here we go.
Yeah, what does this chart mean to you? I got to be honest. This is an eyesore.
It's not. The rallies end as the VIX approaches 20, which is literally yesterday on the dot. I think it hit 20 and a half. And that I mean, for one day, but I'm just saying, if you're buying VIX 30 plus and selling VIX 20, selling S&P on VIX 20, you're doing really well this year. So I think that's the only sustainable pattern that I can find anywhere with respect to volatility in the S&P. It's been a good time.
And once we found it,
well, you hit 20 yesterday. It was a really good day to take some stuff off, for short term. Now tomorrow we could be up another 3%. Forget I ever said this, but just if you look at throughout the course of this year, if you were a seller of S&P or individual names as the VIX approached 20 or even got below,
that is a little bit better.
This is a little bit better. It's been a good time to lighten up, and vice versa. If you bought the panic VIX 30. It might have taken a week or so, but you have been rewarded for the most part, unless you bought absolute garbage.
You know what I was looking at today? The S&P 500 closed today basically exactly where the market opened on the day of, you and I were in the car driving to the city on that day, February 24th, the day of the invasion. We had that huge gap lower, closed at the highs of the day, but that's where we are right now.
Oh, one other thing.
We're where the stock market opened. Go ahead.
Give me the S&P one more time, just like, what is this? All right, good enough. You can't see with my pointer, but can you see this congestion from late May into June?
Top chart or bottom chart?
Bottom chart, S&P 500.
Yes.
You see that congestion?
Yeah, that's where we are right now.
We literally got stopped there on the dime. That's 4150, I think, on a closing basis for the S&P. So there was a lot of rhyme and reason for if you're going to make the case that like the bounce is going to take a pause. There's a lot of rhyme and reason as to why that would happen yesterday and today. So
anything else you want to highlight before we get to some of my charts?
I think that's all I wanted to say. I'm not telling people the VIX got to 20, dump your portfolio. I'm just saying like as that volatility has ticked down to that level, historically it's been a good time to be a little bit lighter. So hopefully people that are more short-term oriented have some sort of a system like that in place.
So the market stopped going lower about 2 months ago. And I did this chart breaking down returns by decile, and it's been broad-based. I mean, only 10% of stocks are negative since then. So 90% of stocks are positive. And if you look at some of these things, so the average gain for the top decile of performers is 50%, 28% for the next, et cetera, et cetera. And if you look at the biggest winners, this is not terribly surprising.
Wait, can you go back? So Russell 1000 average return by decile of what?
Of performance.
So explain what we're looking at.
So let's just say that there's 1,000 stocks in the Russell 1000. Okay. I ranked them by performance, and I did stocks, what the average return of the best 100 performing stocks.
Since the bottom.
And then
even if you own the worst stocks. Even if you own the worst 10% of stocks, you're really only down 6% since then. So there's been almost no risk.
And of the losers, it's rotation. So money has been rotating out of the winners. So I think 50% of the stocks that are down were either energy, materials, or financials.
Well, okay.
And Staples is in that group as well, correct. Okay, so these are all of the stocks in the Russell 1000 that gained 50% from the bottom. Carvana, Affirm, AMC, all gained 100% or more. Plug Flower, Roblox, Robinhood. I mean, these are the stocks that really.
These are the stocks that were down 90. That were down 90%. It shouldn't surprise anybody that they bounced 50% or more.
So guess what? So Carvana literally doubled from the lows. It's up more than 100% from the lows.
Coinbase doubled in a week.
It's still Carvana is literally still down. What did I say? 88% over the last year after the double.
Yeah, when stocks are down more than 50%, I feel like you almost have to throw percentages out because a stock that's been cut in half, even if it doubles, it's not getting back to where it was, like mathematically.
Well, a stock that falls 90% and then doubles, you can't even see the double. Literally, it looks like this, and then boop, you can't even see the double.
Right. They almost require their own measurement system.
I thought that this 60-40 charts that you pulled were really good. Where's this from?
Wait. Let's stay on the heaviest bouncing stocks. And I own some of like the big bouncing stocks. These are my worst stocks in my portfolio, and I didn't need.
They better be your worst.
I liked your chart, but I didn't need it to understand what was going on. And I would ascribe like almost the entirety of the move to interest rates falling back, and people taking a second look at shitty growth stocks. Because they just tend to do better when rates are at zero or look like they're headed lower or whatever. So the bottom almost perfectly coincides with, I think, the bond market cooling off or interest rates cooling off.
The 10-year peaked on June 14th, so 2 days before the bottom. So you're correct there. I just want to make one observation. Just because the biggest losers are bouncing the hardest, that doesn't mean this is a junk rally. Okay, it's not like Apple isn't bouncing.
Yeah, because everything is bouncing.
Everything's bouncing.
I'm with you. I'm with you on that.
All right, keep going.
But if you're bearish, that's like the thing that you're tweeting. Like you're tweeting Carvana charts if you're bearish.
It's a junky rally. Okay.
Yeah. Like this is your leadership group. Yeah. You didn't hear it from me or whatever. Yeah. Don't say I didn't. Don't say nobody warned you. Let's throw these 60-40 charts up. I wrote about this yesterday. These are not my charts. This is from the Man Group, shared by our friend Meb Faber at the Idea Farm. And I just thought, like, this was really a cool visualization.
Yeah, I like it.
So, all right, so let me just set this up for people if they didn't read my piece. The top 5 years here are the best first 6 months in 222 years. The years with the best first 6 months. So 1975 is the most recent one in that group. But you could see years like in the 1860s.
Huh, those are all bear markets, no? 1862, I mean, it's a pretty bearish year. Civil War.
Terrible year. My third wife left me that year. They did a composite of the U.S. stock market and the U.S. bond market to come up with these index returns. The bottom 5 is what we're really concerned with here, though. These are the 5, and you could see 2022 in orange. These are the 5 years with the worst first halves for a 60-40 portfolio in over 2 centuries. And
I don't remember 1877 being that bad.
That might have been like some railroad blow up or some ugly shit. I don't know. 32, we all know what that is. 62 is Cuban Missile Crisis related, yes. Maybe? But wasn't that in the fall? I don't know. 1907, we all know, is the panic of 1907 year. And then 2022, it's like a huge outlier. Like hundreds of years of history. And we haven't had a first half this bad. So my point, let's go through we have one more of these? Same source. This is what happens after. So obviously excluding 2022. These are the 10 years in the last 2 centuries with the worst first halves for a 60-40 portfolio. And as you can see, they're up an average of 10% in the second half of those years. And things did not, only in one case, 1907, did things get worse. So that's a 90% hit rate for an improvement in the second half. And I basically was trying to make the point. I know you hate this point that I make, but I still think it's true. I was trying to make the point that, like, eventually the money has to go somewhere. People have to invest in something. They can't hide out in cash forever. And yes, we don't have the same V-shaped recovery phenomenon because the Fed is not there doing that. They're doing the opposite. But still, the 60-40 portfolio is like a classic mix of risk-seeking and safety-seeking, and it will always eventually find some sort of an equilibrium. And I feel like there's a lot of rebalancing activity in the summer, in the middle of the year. And I think that people come back and they buy something. So sue me if that's not mathematical or quantitative. I just feel like that's what happens. Any thoughts?
I mean, I think the rubber band got stretched, number one.
So we're saying the same thing.
And it bounced. Okay, fine.
I just say it more like poetically.
Okay, sure. I also think that the stock market got it wrong, which is fine. I was wrong. I think the stock market got too bearish.
Or it was early.
Or it was early. Fine. Yeah, could be. In fact, I do think that growth will slow and that the fundamentals will deteriorate. But the market sold off too much.
Before you go into this, the yield curve is still as inverted as my ass right now, okay? It is like the worst yield curve inversion for like the longest duration that we have seen in your adult life. It's still like it's screaming still.
What do you mean my adult life? Like you're like fucking 30 years older than me?
I think I'm a good like 8 years older than you, so I'm just making the point that the last time we saw a yield curve this inverted, you might have been in college, like in high school. I don't know. So it's bad.
Right.
No, I'm saying it's bad.
Yeah, I know.
It's not about you.
So the stock market got it wrong. Why? I'll tell you why. The stock market thought that inflation was going to lead to a deterioration of a lot of things. The consumer, spending, earnings, all might happen. Definitively has not happened yet. We're going to get into more of that later. But as evidence of that, for example, throw up this Apple chart. I'm going to skip over one chart. Thank you, John. This is the June quarter for Apple.
Sick.
And I chose revenue. I could have chose any other metric. They all said the same thing. Apple stock fell 29% peak to trough in anticipation of some sort of slowdown that obviously did not transpire.
Sick. Is Apple though a good yardstick for anything else other than Apple?
Nope.
I'm going to go ahead and say no.
Yes and no. Yes and no. But let's zoom out. Let's look at this chart that comes. I forget. I apologize. I don't know where I saw this. Truist IAG. They got their data from FactSet. Okay. In the first quarter of 2022.
Yo, what? Truist was. Wait. I'm sorry to interrupt your flow. Truist was I want to say it's like these mid-Atlantic regional banks that all merged with each other. I didn't know they were doing Wall Street research.
Oh, I pulled this from Sam's TikTok. From Sam's not TikTok.
Who is Truist is like BB&T Bank.
Okay, cool. Anyway,
all right,
all right. So in the first quarter of this year, as everyone probably remembers, way back when, DocuSign, Teladoc, all of these stocks that were down 70% going into earnings, and you could have easily said, listen, I think the worst is priced in. Wrong. They were down 70% and then fell 20% the next day. Like that happened not long ago. That was in the first quarter. And it's very rare. In fact, we haven't seen this in the last 5 years at least. The average change for stocks that miss earnings, throw that back one more time.
Yeah, John,
the average change is positive. So stocks
wild.
are missing. And finally, we know that the bad news was all absorbed already. Why?
That's
why?
Wild.
Because I'm painting with too broad of a brush here, but the misses in certain cases either weren't that bad or were fully priced in.
The only flaw, not that this is flawed, I would just love to see this for the NASDAQ because that's where the real misses are. Like when you're looking at S&P 500, bro, this is like Procter & Gamble. These companies don't miss.
So what?
They don't miss.
What did Robinhood do after it missed?
You think Robinhood's in the S&P though?
No. I'm agreeing. No, you're saying NASDAQ. I know Robinhood's not in the NASDAQ. It's a tech stock. Robinhood, the report was terrible. Zillow's report was terrible. And the stock wasn't down much. It opened down a lot and closed positive.
Speaking of, we have Coinbase out after the close.
Do you want to get into that or no?
Yeah, let's do it. It's not that bad.
What's not that bad? It's terrible.
When I saw the size of this loss, I said, this thing's going back to 45. They lost so much money.
It's down 4% after hours. Not so bad.
On such a horrendous fall in revenue year over year. It's so. I mean, I knew it would be.
I've got the numbers.
Okay, let's do the numbers. So this is Coinbase Q2 earnings, and they lost almost $5 a share or $1 billion. And they in the same quarter a year ago they earned $6.50 a share or $1.6 billion in profit. So that is like a huge swing in the pendulum from last year to this year. And you've talked a lot about why.
Net revenue was $803 million, down 31% compared to Q1.
And down from $2 billion a year ago.
Total operating expenses were $1.9 billion. So do the math. Up 8% compared to Q1. Stock-based comp, which we've spoken about a lot, is now, what is that? I don't know, 40% of revenue. Stock-based comp went from $352 million to $391 million. And they laid off 18% of people. So retail trading volume down 70%. Institutional trading volume down 46%. I don't really know the business, obviously, but how is transaction expense as a percent of net revenue 21%? How does it cost them that much to trade?
Honestly, I can't understand that either.
There was something about mining fees or something like that. I don't even understand.
Even the good news is bad news. So retail volume dipped to 46 billion from 70. By the way, I said this on TV today. If you're bullish on Coinbase, then obviously you think Bitcoin is going up. Just buy the Bitcoin. Like, don't torture yourself. It's not that this can't outperform Bitcoin in any given period of time, but is it likely that this works and Bitcoin doesn't? So you know what you don't have with Bitcoin? You don't have the risk of fucked up management execution and regulatory stuff. Like, you just don't have the same layer of corporate risk on top of the already volatility of crypto asset class.
So I shared this with you before we started. This blew my face, like in a real way. I'm looking at transaction revenue from retail and institutional, which they break out. Retail transaction revenue is $616 million for the last quarter, which, by the way, was $2.1 billion in the fourth quarter. Oh, my God. But okay, $616 million for retail. You know what institution pays? $39 million. And the kicker is that institutional trading volume was $170 billion compared to $46 billion. So institutional trading volume was like...
is 5x and
a
tenth as profitable?
Retail transaction revenue was 16 times more, and it was only a quarter of the size. So their fees, if you just look, hold on, let me just finish. If you just look at like basically commissions, revenue divided by volume, 1.3% for retail, 0.02% for institutions.
So thought experiment. Where would this stock be if retail were paying the same transaction fee that institutional is paying?
It would be an FTX.
It would be a $10. It would be a $10 rescue. So the only thing that's keeping like the revenue line even close to where, at least for right now, is the fact that they are able to charge so much more to retail, and we know that's not sustainable. Just in the history of Wall Street,
so does the market. Business. In fairness, the market knows that too, obviously.
Yeah, but the market has given them the benefit of the doubt that they're going to expand into other revenue lines.
No. Market has given them the benefit of no doubt. Dude, stock's down 90%. The market has given them no benefit of any doubt.
Okay. So the market now assumes that retail commission take rate or whatever is going to slowly
collapse,
gradually drift back down to where the institutional take rate is, which might also shrink. And then here, this guy from Mizuho, Dan Dolev, is an analyst. He called the latest performance, quote, very weak. Yeah, really?
Yeah, no kidding.
Institutional volumes declined to $171 billion from $235 billion. Dolev said that while Coinbase's retail take rates actually ticked up by 3 basis points, that change, quote, may simply be a reflection of share losses in the prosumer high roller pro space to platforms like FTX. So the retail, like FTX is obviously sucking all the oxygen out of the room and maybe even taking share away. So even if the whole pie is shrinking, they're saying like Coinbase is not even keeping its piece of the pie relative to the rest of the space.
When institutional investors come in a real way, BlackRock, for example, they are going to Coinbase.
Says who? Why?
Says BlackRock. What do you mean? Well, I don't know. Ask them.
No, that's not what they said. I have a huge problem with this. I watched this stock go up like crazy on this BlackRock quote unquote news. I think I'm the only person in the world who actually read it. Did you read it?
I did not read it.
So what do you think they're doing with each other? Just take a guess. And then I'll tell you. But just like guess what this partnership is.
Okay. I would assume that BlackRock's institutional clients are using Coinbase as their broker.
No! And that's what everyone thought, but that's not what it says. What's actually happening is that BlackRock is not committing to buying anything on Coinbase or sponsoring its clients buy anything on Coinbase or even like any kind of marketing agreement or anything. All it is a data feed from Coinbase to Aladdin so that BlackRock customers using Aladdin as risk management
you got to start somewhere.
Can pull that data in. You got
to crawl before you can run.
Okay, but like, I don't think the stock should be up 40% on a data feed agreement. Call me an old fashioned kind of gal.
You say up 40. I say down 79.
Fine. All right. I just thought that was. I thought that was a non-event.
Okay. So anyway, in conclusion, the stock market sold off too much. We now know because fundamentals did not deteriorate nearly to the amount that stocks fell. However, you can say yet, and you can also say, hey, guess what, jackass? Stocks were overvalued in the first place. And that's fair.
Yeah. Today is August 9th, and in 21 days, the Fed begins actually quantitative tightening. So let's all reserve our judgment as far as whether the market got ahead of itself. Let's reserve. Let's just reserve. Okay.
No. I will not reserve. I'm saying that in hindsight, we now know that the market fell too much. In hindsight.
For now.
We have CPI tomorrow. We have whatever we have. All right, keep going.
For now. Okay. Also, nobody's trading. Everybody's on vacation. Okay. Homesellers cut prices as housing market cools. I am in the camp that I am reading these articles, and you're probably reading them all day now, as good news. So, really quickly, for much of the country, real estate had been on a tear since the start of the pandemic. Home prices are up 44% over the past 2 years, according to Redfin. but prices have cooled lately, and many homeowners are coming to grips with the reality they may not get the same prices their neighbors did. Roughly 1 in 7 homes on the market had a price reduction in June. That's nearly double the rate of 1 in 13 homes a year ago. To which I say, if you were seriously trying to sell in real life and not just commenting to a Wall Street Journal reporter for an article, you would have sold. And so I actually think this is great for affordability, and I hope the home prices go lower. What are your thoughts?
I could not agree more. And I actually think that the market is still not scorching, maybe not red hot. The market is still hot, but it is turning. So let's just look at some charts to paint a picture of where we are, where we came from, and where we might be going. Chart on, please. Okay. We're going back to 2020, 2021, and 2022. And this is showing you that on average, over the last 4 weeks, the average home is still selling for above the list price, but that is clearly turning over and going south.
Oh, wow. Fast.
Okay.
That's a
next
fast
chart.
roll. That's a fast roll.
So this is similar, but different data. 45% of homes are selling above the list price. Still, I mean, forget 2020. Forget 2021. These are both anomalies. But again, the point is, look at the direction.
Do we know where a measure like this bottomed out, like in previous
in normal
down
times,
cycles for homes?
I don't. But still, it's still 45% of homes are selling above the list price. It's still too high, but it's coming down. Okay, next chart. So this is like showing the blistering pace. This is the percentage of contracts of sales that are signed within under 1 week. So basically, the home goes up and boom, it's off the market. And again, this is rolling over. It's still fairly high. 25% of houses sell within 1 week or go into contract within 1 week. But again, the direction.
That's what matters. And a lot of this is just normalizing. It's not like the housing market is crashing or is gonna crash.
Dude,
it's so far from normal still.
Most houses are still selling for above the asking price. Next chart, please. This one comes from Altos Research. More price reductions now now we go back. Okay, so now you could see that 2021 was off the charts, that 2022 was, but we're normalizing. So more reductions now at this point in time. Obviously, housing is very, very seasonal. Yeah. Than we've seen in a long time.
Right. Just like to handicap this, keep this chart on. If you just like next to each one of these lines wrote the prevailing 30-year mortgage rate, like it would make perfect sense to anybody looking at this. Why the price reductions would be rising faster this year than in any other year.
Well, because prices it just became, at some point there's a tipping point where whether it's the prices and the mortgages or
the number's
both.
I think the number is 6%.
What number?
When psychologically, even though mortgage rates have backed off since, when they got above 6% and stayed there for a week or two, I think the psychology, the downward psychology in the market really took hold. And look, the housing market is not like a stock chart. It does not zig and zag on a dime. So
actually, next chart, Josh, I got a question for you. Is this an inverse head and shoulders?
What is this? This is inventory.
So yes. This is showing this is.
I would bet on the higher inventory. Yes.
This came out today. It's showing stale inventory, as you could see, and it's showing. Let's just use 30 days for example. The percent of total inventory that has been on the market for 30 days is breaking out. So more than 10% of houses have been on the market for 30 days, and we haven't seen that in actually quite a large number of years.
Calling this an inverse head and shoulders is quite possibly your greatest chart crime to date.
Thank you.
So congratulations on that. You never let me down. Anyway, I'm reading negative housing news as positive.
Yes.
For stocks and society and the next generations.
I wonder if the headlines, if the news is going to get nonsensically hysterical, as if home prices that are up 44% in the last 2 years and now dipping 5-7% is like, you know what I mean?
You know what I want to do, bro? I want to create like an index and sell it to Morning Brew and BuzzFeed and outlets that cater to younger readers. And I want to be like, affordability spikes 5% in July.
like
I want to like sell an inverse on affordability index, like an affordability index, and that way, when prices are down 3% a month, I could be like, yo, affordability climbed 4.1% this month. You know, like factoring in like the price to borrow, the average home price, etc.
That's good.
Like if we're only talking to people who are 75 and selling their last home before checking out and going into a retirement community, then yes, all of the housing headlines you're going to see for the rest of this year might sound really negative. But like most of the labor force is more closer to in a position where they want to buy a house than when they want to sell their last house. So I feel like this trend should be celebrated and not treated as like it's some negative indicator. It's not. It's what we need. Anyway.
Okay. So there's been a lot of debate about whether or not if we're going into, but whether or not the U.S. economy was in a recession in the second quarter, first half of the year. And I just want to point out one very obvious thing that does not happen in a recession. Just one thing. Here's what I got from Nick Colas, DataTrack. He said, even with the slowdown in economic activity this year, the S&P 500 is on track to show a record quarterly profit in Q2 of $56.45 a share. Again, going back to my point that stocks got ahead of themselves with the pessimism, guilty. Stocks got ahead of themselves to the downside. That does not happen in a recession. I think that's obvious, but it's worth saying.
What do you got?
Record profits and recessions do not go hand in hand.
No, but record profits often precede recessions. So you don't have to think that we're in a recession now. And obviously, you don't add 3 million jobs in 2 quarters, even if those 2 quarters have GDP contraction. You don't add 3 million jobs and say you're in a recession. But record profits, I'm pretty sure, have preceded every recession on record.
Fair, but that's not what. But I'm only saying that we weren't in a recession. I'm not commenting on the future.
Do you think a lot of people thought that we were already in recession?
Yes, and when the GDP number came out, they said, boom, there it is. Told you. Let me ask you this. Do we need a...
But wasn't that... Wait, back up, though. That wasn't like mainstream Wall Street economists. That was like political hacks that hate Biden.
Not really. Not only.
So you thought there were like thoughtful professionals working on Wall Street that went, up 2 quarters of negative GDP. There it is. I didn't see any of that, dude. I really did. Even like the people who get paid to be bearish weren't really like hanging on that one data point as much as they could have.
Here's what I wanted to ask you.
Okay.
I still think that with the Fed removing liquidity, with interest rates rising, with inflation rising, even if it has peaked, that stocks needed to get re-rated. Their multiples needed to compress, and they really haven't that much. So but at the same time, I ask you this: if the news doesn't soften, if the data doesn't soften, do we need a catalyst for stocks to take out new lows? Like, I don't think that they could just. But it
is softening.
I think. Hold on, because in order to take out the previous lows, what we need is Apple, Amazon. We need those stocks to fall like 20% from here. What's the catalyst? Is it just softening data? Is that it?
No, we just got profit warnings in the last 5 days from some very important companies, semiconductors. We got Micron, NVIDIA. These are big market cap tech stocks. They're not in the communications index. They're not in consumer discretionary like Amazon. These are like hardcore tech. And I don't know that I would say they're leading indicators for Apple, but they are very much playing in that ecosystem. And so Apple may not have felt the effect of people buying less shit just yet, but the ordering is slowing down for PCs, for tablets, for phones. Like, we're hearing it now from the biggest chip suppliers. So we didn't hear it from Taiwan Semi. They said full speed ahead during this big bounce up, which I think was very supportive and helpful. But we're hearing it from like NVIDIA, and that's a $450 billion market cap.
So a soft Q3 earnings, that's where stocks go lower?
Let me just make my point. My point is the S&P 500 doesn't come out and warn on earnings. The phenomenon is it's one company at a time and during the course of various quarters. It would be very unlikely for the 500 best companies in America to all feel the need to take down estimates in the same quarter.
But you also had companies raising guidance.
That's true. That's very, very true. But if you deconstruct a lot of the raised guidance situations, it's inflation driven, like nominal terms, like, oh, revenue is going to be up 5%. Yeah, no shit, because you raised your prices by 5%, right? Like we don't inflation adjust revenue and earnings figures from companies.
Well, the weird thing is that a lot of the companies that we're raising are hospitality, leisure, and travel. And I think one of the things that maybe people got wrong, myself included, and energy, is that people we were saying over and over and over that the consumer has maybe never been better prepared to enter a recession if we do enter one. We were saying that the entire first quarter.
Yes.
Maybe that turned out to be true.
I think it is true.
And that people were still traveling, but eventually the savings will be depleted, and so maybe the effects of inflation are on a big lag.
Yeah, no, I think that's absolutely valid. Like, yeah, there's a slowdown and there are layoffs, but people are still in really good shape relative to the shape that they've been in going into prior slowdowns. But one thing we know for sure, and I'm investing based on this concept, is that credit card balances are back in expansion mode for the first time since pre-pandemic. So for the first time since the onset of the pandemic. And again, that's another thing that, like home prices, it's a battleship. It doesn't like stop and start. It's not a herky-jerky motion. Once people start to push more of their lifestyle expenses out onto a credit card, materially, things are changing in their situation. And it very often it almost never goes back the other way where they start becoming net savers again. So again, it's not the end of the world, but just another thing to look out for.
Hey, before we move on, what the hell is this? Jeffrey Kleintop tweeted this. This is basically the S&P 500 of Europe. I don't get it.
Europe is banks, oil companies, miners, and telephone utilities. That's the whole index.
Okay, but
so does that now make more sense to you?
Not really. I thought they were I thought they were in a recession.
They will be, but the banks were able to over-earn because there's actually positive interest rates in places like Germany for the first time in 4 years. And energy stocks, like gigantic energy companies like Total, this is what dominates the European indices. They don't have like Netflix shit. You know what I mean? They have like mining companies and energy companies and big telecom companies and banks. And so I think that probably explains the better than... Think about the sectors I just named. That's what's leading the markets here. You know what I mean? So that actually makes sense to me.
All right, moving on.
I will never look at Europe versus the U.S. as a geographic story. For me, it's just always going to be industry domination of the index. And I think that explains most of what we see there. Buyback tax. What are your thoughts?
Good grief.
Stupid.
Good grief. I mean, it's not just the buyback tax. It's that, you know what? Keep your carried interest. We're gonna hit him over here. I mean, this is like everything that people are mad about, myself included. This stinks.
So let's break this up into two things, though. The buyback tax, I heard somebody say this is like the camel's nose under the tent. I absolutely agree. It's starting at 1%. There is no way it's still at 1% a few years from now. It's only going up. If they're taxing dividends, equity dividends for people making more than $250,000 a year at 23.8%, there is no way we're going to leave this buyback tax at 1%. I'm not saying you'll get parity, but one is going up. To me, it seems very obvious that this is just the start of something. And
what is even the rationale for taxing buybacks? It's just a political nonsense.
It's a revenue source.
Yeah,
it's a way for progressives to say that they got something that they wanted, because cinema was not going to give them the carried interest, the doing away with the carried interest loophole, because cinema, when she eventually loses her election or gets bored of attending fireman pancake breakfasts and kissing babies, will go into private enterprise, and there's probably a board seat waiting for her at Blackstone or at KKR, and that's how our democracy works.
Stinks.
It only took a campaign contribution to one member of Congress to block or to preserve the carried interest loophole. And exactly who you think runs the show really reveals their hand this time for all to see, and we all act like it's business as usual. But that's what happened. Like there's no, you cannot be in denial of how that just went down. It's literally money changing hands for legislation at the 11th hour.
Yeah,
and
gross.
it worked.
Yep.
And it worked.
Money talks.
So for those who are not aware of how the carried interest loophole works, basically the very, very wealthy and successful people managing private equity funds are being taxed as though it's investment income rather than like wages. And so instead of paying 43% in the top tax bracket, they're paying 20% or 23% with Obamacare on their long-term gains.
I mean,
so
what
that is a
are we
huge
even
tax
doing?
advantage. And they somehow, doesn't matter, Republican, Democrat, that's just a smoke show. This is like how it really, really works. Oh, I have a post I'm going to write. I'm not going to like do the post now, but the difference between private equity and crypto. It's really just crypto's not mature enough to understand how the game works. They haven't bought enough people. They haven't spread enough money around. They haven't gotten enough people elected, and they haven't hired enough of these people's children at their companies. Like John Thune's grandson doesn't work for FTX yet. You know what I mean? Like that will take a little bit of time because crypto is such a young industry, but they haven't bought the Congress yet. And that's why there's still a carried interest loophole, but the crypto guys are getting their fucking doors kicked in. So it's an interesting time to watch how one very professional group of lobbyists wins, and then like this ragtag bunch of crypto kids, they're like, wait, we gotta get our shit together. We gotta get in the game. Anyway, that's what's going on there.
Okay, you are. That is a good take. I take that only you can make, but you're 100% right. You're 100% right about that. Okay, let's talk about the Fed pivot. So we got early indications. So you might call it evidence that inflation peaked. We're seeing all sorts of the biggest inputs come in: energy, commodities, gasoline. Wages not yet, but it's all coming down. So Renaissance Macro Research tweeted, "Is this more ammunition for a monetary policy pivot?" According to data from the New York Fed, 3-year ahead median inflation expectations fell to 3.18, the lowest since April 2021. Okay, so Bill Dudley, formerly was he in New York?
Who, Dudley?
Or Atlanta?
Yeah,
where was it? New York?
I think he was the New York Fed president. He's like the truth teller now.
Yeah, I think he wrote a book. Anyway, he wrote a piece in Bloomberg, and I'll quote him. He said, investors have lately become strangely optimistic that the Federal Reserve won't have to tighten monetary policy much further, bidding up stocks and bonds amid hopes that the Federal Reserve will soon get inflation under control.
If you're bullish, do you want them to pivot? Do you want the Fed to pivot? I don't think so. Like, I think you want the Fed to beat inflation.
Well, let me just finish.
Okay.
He said, wishful thinking in markets only makes the job harder. By loosening financial conditions and requiring more monetary tightening to compensate, this wishful thinking is both unfounded and counterproductive. In other words, with financial conditions easing, basically stocks bouncing and commodities falling, you're actually making the Fed's job harder because they're trying to stop that. They're trying to make conditions tighter, and this is counterproductive.
Okay, so right, we should not have back-to-back 75 basis point rate hikes that result in financial conditions getting easier. But when the market front runs the Fed pivoting, that's exactly what happens. And then you throw in this $780 billion inflation, whatever the Biden people are calling it, like it's just more government spending.
So do you think
this is all counterproductive?
When Jerome Powell gets off the stage and he's like, what did the market do? And they're like, 4-month high, Nasdaq's up 3%. Do you think he's like, for fuck's sake, or do you think he's like good? I don't think he's happy.
Wait, who?
Powell. Jay Powell. Yeah.
No, I don't. It's not. I don't. It's not happy or sad. It's like he probably just like, well, Guess I'll keep going then. These people aren't listening. Like, what? Powell's like, wait a minute, let me get this straight. Roblox just doubled? Oh, fuck that. 50 more basis points September, and we're going again in December. Like, he has to be thinking that way.
Stop.
He has to. I know he's not supposed to. I know he's supposed to be looking at core PCE and blah, blah, blah. But he's got to have one eye on ARC. He has to. And that's gotta be like his way of knowing, nah, they don't get it.
I mean, I think the big risk is just a policy mistake, is that they continue to push as inflation has peaked and growth is already slowing, and they just push a little bit too far.
Yeah, fair. I don't think they want a recession, but I think they'd rather have a recession than still doing press conferences a year from now talking about 6% inflation. You know what I'm saying? Which would produce a recession anyway. So it's almost like it doesn't matter what the Fed does. If inflation stays where it is, you're going to have a recession either way. So I don't think a pivot would be bullish at all. All right, let's bring in Duncan and do viewer topics, then we'll get out of here.
Hey, guys.
Duncan, were you in London?
I was.
All right. How long were you there for?
London for 5 nights, but we were in Edinburgh and Glasgow and Liverpool before that.
Ooh, that's quite a trip. I've never been to Scotland. I've always wanted to go.
It was cool. It was great. Yeah.
Awesome.
And we have viewers in Scotland and in London as well. But
that's true.
Yeah, it's pretty cool.
That's true. Well, welcome back. What do we have for our first viewer topic, sir?
Okay, so speaking of our international audience, Guten Abend, I believe, is good evening in German. We have a question from Johann in Berlin, who writes, could a 1929 style crash happen again? What would it take for that to occur?
No, I'm going to say. Michael?
I don't think so. I think Fed policy at the time was they had no idea what they were doing.
There was no policy.
They were denying, the White House was denying that anything was wrong for like 6 quarters. You could not have done things worse back then. So can stocks fall 60%? Yeah. Can they fall 89%? I don't think so.
There was not even a reason for the crash of 29 other than excessive speculation and leverage. There wasn't like a trigger. And I wrote my first book, I wrote a chapter on my second book. I wrote a chapter about did a market pundit cause the crash of 29? Like,
what was
that day.
Name? Babbitt, or is that somebody else?
Roger Babson, you probably know Babson College in New England, gave a speech that was like piped in. He was in Massachusetts at his school, but they piped in his speech over like the speakers on the New York Stock Exchange, and he was bearish. That's like the only thing they can come up with. There is nothing else. Somebody said the day of the crash was the day they put the cap on the Empire State Building. Like, people are really that's true. That's actually a true story. In 1929, that's when I think it was either the Chrysler Building or the Empire State, maybe the Chrysler Building. They put the silver cap on, and that was the top of the market. But people are really reaching. So, like, we don't even know what caused it to this day. But what we do know is the market back then, to your point, Michael, was primitive, and so was policy response. And I also think that most of the people involved in the market were not professional investors. They were speculators. It was for gamblers. It was not for retirement portfolios. So I think that there's too much at stake now societally, and there are too many professional investors, and there's not nearly as much reckless speculation or leverage as there was back then relative to the amount of real equity that's in these businesses. So I don't think it could happen again.
Yeah, I'm with you. All right, Duncan, next question.
Yeah, I enjoy those big picture questions because we talk so much about the day-to-day movements and stuff. I think those kinds of questions
there was no
fun.
FDIC if you were caught up in the crash of 29, you weren't worried about your stocks. You were like, shit, is my money in the bank going to be okay? Like, that's a whole nother level. And I know people worried about that in the 08 because the center of the crisis was the banks. But like, I just don't think, based on new legislation and the way that we're policing financial institutions now, that risk is still on the table. So what could cause a 90% crash for stocks? Like, alien invasion is like, or like a nuclear bomb. But like, I don't think you would have a crash like 29.
They would turn the stock market off before it got to that point.
Right. Well, right. We have circuit breakers now, multiple circuit breakers. We didn't have circuit breakers then. So like, that's a crash that we can't even explain. Right. So I don't think that you would have that now. If we did have a really big crash, which of course could happen, I feel like the explanation would be pretty obvious to all of us in real time.
Mm-hmm.
Cool. Okay, so up next we have a question from Kelly, who writes, "Hey guys, what actually defines a recession? I've always thought it was 2 consecutive quarters of negative GDP growth, but wait, it seems like there are many definitions. Which one is right?" And I have a personal quick follow-up to this. I, a while back, just for fun, did like that SIE practice test because I was just curious how I would do on it, and I didn't do that well. But one of the questions was literally, what is a recession? And the answer was 2 consecutive quarters.
Okay,
negative
that's
GDP.
not right, and that's never been right. If you go to the National Bureau of Economic Research is the agency that defines what a recession is, and they say a recession is a significant decline in economic activity that is spread across the economy and that lasts more than a few months. It has never said, at least to my knowledge, because I remember looking at this a decade ago, it has never said 2 consecutive quarters. As a matter of fact, for people that think that the White House is moving the goalposts, Jason Zweig asked this question in 1987, which is 35 years ago. He said, the financial press often states the definition of a recession as 2 consecutive quarters of decline in real GDP. How does that relate to the NBER's recession dates? And the answer was, most of the recessions identified by our procedures do consist of 2 or more consecutive quarters of declining real GDP, but not all of them. In 2001, for example, the recession did not include 2 consecutive quarters of a decline in real GDP. Anyway, the point is that is not and has never been actual definition
and also
of recession.
widespread job loss is a big ingredient to it. If you listen to what they say, and that doesn't exist right now. I think credit losses, which there are none.
But it is vague. It is vague. They say a significant decline in economic activity.
Okay, well let's put it this way. If you feel like you're in a recession right now based on like your financial situation, it's very possible that you yourself have had a big enough setback to cause a personal recession. But if you look at like nationwide data in anything that you want to look at, it isn't one. Like it's not. Unfortunately, it's not.
You don't add 528,000 jobs in a recession. You don't have 3.5% unemployment in a recession.
Right, so it doesn't mean we won't have one. I think we're about to, but like it's not here, and it's not political to say that it's not here.
Okay, so what do we learn?
I'm not like a Biden guy. Just believe me, this is not a recession. They say a recession is when your neighbor loses his job, and a depression is when you lose yours.
That's a good definition.
So, that's a good definition, right? Okay.
Yeah.
All right, Duncan, what do you got?
Okay, and so last but not least,
we got a bonus.
We have a bonus from the chat.
Bonus.
This is a good question. We've gotten this before from people just off the cuff. So Eric Barris from the chat asks, "Can I throw a curveball at you guys? Early 30s, work from home, professional in a major city. How does one make friends nowadays?"
Man, this is such a tough one. I had to think about this for a second. Michael, you're in your 30s. How would you make brand new? You make new friends all the time. What's your secret? You do though. I watch you. You're like a social butterfly. You're always like doing these like random coffees and shit.
Every day.
Tell me who you're meeting.
Every day, lunch or a coffee or something.
You got some stuff going on. So tell us, how do you make new friends?
Well, you start a podcast.
Okay.
There should be a
and just invite people on that you want to be friends with.
There should be Tinder for
dudes.
For man friends.
For friends.
For dude friendships.
I mean, first of all, I will just say, I Love You, Man is one of the greatest comedies of all time. I love that movie. How do you make friends? I have no idea. I really don't know.
You have to do something.
Oh no, sports. Go play basketball. Go to the gym, play basketball.
I was gonna say, like, depending on like if you're athletic, it's probably easier. Like, go to a CrossFit gym. There's a lot of lonely people doing softball. Yeah, hey, bro, you need a spot, bro? Or if you're like a weirdo, like maybe get like really deeply involved with conspiracy theories.
Okay,
and
stop. I think probably sports, bar. I don't know how you meet like a group of fantasy That's
Somebody's
tough to
saying
break into.
Bumble BFF literally is Tinder for friends.
Oh, there you go.
There's a
That
thing
makes
called
sense.
BFF on Bumble.
Listen,
Maybe
that
some,
honestly makes.
book clubs?
There's a lot of people that are probably new to a city and would love to make new friends. Like,
Oh, you know what I told that kid that works for us, Alex, the trader?
yeah,
And I think it was good advice. He's from Minnesota. So I was like, when he first started, I was like, yo, every Sunday, there's like 2 or 3 bars in New York that have the fans of every NFL team.
Yep.
There's definitely a Vikings bar in Manhattan. I don't know what it's called, but I just probably 3. And they were the same thing for colleges too. So I don't know where you went to college, but I said, go to a Vikings bar on a Sunday, watch a Minnesota game. There'll be like 10, 12 dudes there that are expats from Minneapolis that you can meet. And I think he listened to me. I'm not sure. Maybe he didn't listen. And I'm just like pretending that it was good advice.
yeah,
But
that's
like
tough.
a
That's
thing
a
in New
good
York.
question.
In New York, you could find your tribe easier than some other major cities. Like, I feel like your tribe exists. They're just waiting for you to find them in a place like Manhattan.
I feel
There
like
should be a
people
bar
aren't
for-
super nice to strangers in New York, though.
Nah.
And so, like, you're a stranger until you're a friend. You know,
You ever
I
go
mean,
to
so
North
it's kinda
Carolina?
hard.
You ever go to like a North Carolina bar in New York? What would that even be? Like Brother Jimmy's? Where
It would,
they probably
it
hate
would
that
be like
place.
a barbecue place.
Imagine if there was a bar for balds.
That might exist. You could start it.
Ooh.
That's my tribe.
I like that. All right. We're gonna let everybody go. We're gonna remind people that tomorrow is Wednesday morning. Brand new Animal Spirits, as always, with Michael and Ben. Do not miss it. We'll be back with an all new The Compound and Friends later this week. Thank you guys so much for coming through tonight and puzzling through the biggest questions in the market with us. We have a lot of fun producing the show, researching the show. Thanks to Sean. Thanks to John, Duncan, Nicole. We'll see you all next week.